Good day traders, this is the daily market rundown live from the Tradelo Trading floor. It's October the 22nd and some highlights from today's show. Euro is back to parity, is now back in play, US election updates, and BTC longs are providing liquidity. Good day traders, let's then start with some of the overnight news. There was an Ipsos poll that came out. It was looking at the US elections and it actually puts Kamala ahead of Trump by 46 to 43. Now again, these polls you always have to take with a large degree of skepticism. Of course, we've got a number of different polls, we've got a number of different betting outlets that show all sorts of varying degrees of potential probabilities. But I think the key takeaway from this poll, which is very interesting, was what ultimately voters were asked on and where voters were showcasing their concerns. And there was three areas. One is that 70% of the registered voters in the poll said that their cost of living was on the wrong track. Okay, and that's a significant amount of people pointing towards, inflation has really hurt us, and that's a key concern for us. We then had 60% saying that the economy was headed in the wrong direction. And then finally, 65% said they aren't happy with immigration policy. Now, if we look at just those three policies, you would very much think that Trump is a far better candidate, just if those were the three major concerns for voters in general. Now, what you take away from that, I don't know. But if we look at what is concerning voters, generally speaking, Trump is going to be a far better candidate to address those key concerns. And I think that's one of the key takeaways from that poll. Now, another piece of news which is quite interesting, and this was the highlight of yesterday's session, was we did have quite a bit of trouble in the bond markets yesterday. It was quite a prominent sell-off. It was led by the back end. The curves were steepening in every major bond market, basically. And what led this, or what created this? Well, I think there's a number of things going on here. I don't think it was anything fundamental. Sure, the newspapers will tell us it was something fundamentally driven, but I suspect it's a combination of right now we know that volatility is higher than normal in the bond markets. Why? Well, we've had a higher volatility in the bonds all year, but we also do have an election in about 2 weeks' time. Don't forget also we had a lot of positioning in the bond markets for the last 3-4 months as the US economy slowed. Everyone was long the back end. Everyone was looking for an imminent recession as the labor market was slowing. So perhaps there was a little bit more of a squeeze on those long positions. And that's pretty much what we saw yesterday in the bond space. Now, what confirms this isn't really a fundamental move is that the rates curve has barely budged. Okay, right now the implied pricing for a rate cut from the Fed at the November meeting is still around 21-22 basis points. So it's very much consensus that they are going to cut again in November. And that leads me to believe that most of this move in the back end is perhaps now done. Sure, we could get a little bit more movement in the back end of things, but it's very much the front end where I'm interested. I do think now you want to be looking for some advantageous buys of 2-year bonds in general. Why? Well, because the curve should keep steepening. And if the back end does at some point bounce, you are going to get paid out quite nicely being long the front end of the curve. Okay, let's then turn our attention and talk a little bit about some of the overnight moves. We of course had that bond sell-off. We've seen a little bit of the steepener continuation, particularly in Europe today. So it's very much the steepener is in play. But we had some news from Mary Daly yesterday. I think that was quite important. She came out and said, look, her base case is we're still going to cut in November, and we should definitely not be getting ahead of ourselves in terms of worrying too much about what comes at the next meeting, simply because they are on this path of cutting rates because they want to get a little bit closer to neutral is. Okay, where neutral is, they're not so sure, but they know that policy is very restricted right now, and the last thing they want to do is see further weakness in the labor market. Okay, we also had, of course, Gunnar coming out, sort of talking about his trade of effectively higher yields in the back end. Now, again, we always have to be careful as traders. That doesn't mean he's short outright back end. He's probably got some form of a steepener trade on, and he'll have it done in some exotic way that ultimately limits his exposure but maximizes his opportunity should long end yields blow out. But I think there was a little bit of that involved yesterday. Perhaps some people picking up on that news and perhaps bailing on those long positions. But the key takeaway is that nothing fundamentally has changed, and I think we do need to stick to this idea that until we get more eco data, we are likely to see the rate cut cycle continue as expected. Okay, let's then go and take a look at some of the key charts. I think the first one is this concept, or our first topic of today is all about euro back to parity. Now, this was a play that over the course of the number of years has played out. It's kind of come back in vogue recently. Why? Well, because we've now got a flip in terms of the rate differentials. What you're looking at here is, in the orange, we've got the one-year rate differential between the US and Europe. And what we can see is we're almost at the highest level for 2 and a bit years. Okay, in other words, things have that drastically flipped where we have a very robust, strong US economy, and at the same time, we've got a very weak European economy. And that's created this sort of almost a V-shaped reversal in the rate differential between Europe and the US. So what is a rate differential in a basic sense? It's the yield that you can achieve by holding a 1-year European bond versus a US bond. Okay. Now, what this is pointing towards, or what we typically use this rate differential for, is that when those rate differentials being offered by one country over another widen to such a degree, we do typically see strength and weakness in currencies. Okay, and so that's what we're expecting here, because this rate differential now is heading back towards that 2% sort of difference, or that spread. We should see that euro continue the path of least resistance back down towards 105. Okay, this is very much a very strong consensus call. I'd be very shocked if we didn't see 105 at some point over the course of the next 3 months, particularly if we do continue to see strong US data. Okay, so right now, euro is not a buy. You definitely don't want to be touching this euro. It's very much a sell-only market. Sure, it's a bit oversold. We spoke about this last week. It's a little bit oversold in the near term. Does that mean it can't go further oversold? Of course not. Okay, this is not a market we want to buy. We only want to be looking for some sort of tactical shorts all the way back down to that 105. Okay, that is the euro play, and no doubt once we can take and get below that 104, 105 area, if the yield differential does continue up because perhaps Europe enters a recession over the course of the next couple of months, no doubt we will be moving our way back towards that parity against the dollar. Okay, just an update on our US election. Like I said, we had the Ipsos poll that points towards Kamala with a narrow lead, but the the Polymarket poll has gone even further in favor of Trump. Now, sure, this is the betting market. As of yesterday, it was around 61. We can see that's up to 64 now. And what that means is we need to pay attention to some of our key markets. Okay, we've mentioned the Mexican peso, of course, the Chinese yuan. We mentioned the financial index in the US. These are all key markets that are pricing in a Trump sort of victory in both, of course, the presidential race as well as winning the House. And we can see in the Mexican peso that very much it is the case that they are betting against or betting for a Trump victory. Okay, we can see the Mexican peso is up almost 4%, or down, sorry, against the dollar 4% since pretty much the start of October. We continue to maintain that bid. Okay, what we can see over the course of the last 4 sessions is, sure, that momentum is not quite as strong as it was perhaps earlier in the month, but right now what we can see is that no one really wants to be short this market, and perhaps everyone's hoping for easier bids to try and get long. Okay, don't forget, we of course are seeing a very strong dollar right now. If that US data does continue to come out strong, that's going to help this trade significantly. So there's sort of almost two tailwinds for this trade. One is, of course, that we are in a very strong dollar environment as the US economy is very strong, and perhaps the Fed may not cut as fast as the market expected. That's the one tailwind. The other, of course, is if Trump does come into power, the Mexican peso is going to come under some sell-side pressure. Okay. Now, from a technical standpoint, we can see that we've got some very key significant resistance here at $20. Does that break now ahead of elections? Perhaps not. You're going to need some catalyst to get through there. We can see it's been very important resistance for all year. But above 20, this market does break out into price discovery mode. And in that, there will be some key opportunities to trade this to the upside. Okay. And then finally, our play of the day, it's back to Bitcoin. We spoke about this last week. We spoke about this opportunity coming. We spoke about how at some point it's going to flush out, and there is your flush out. Okay. Pretty aggressive sell-off yesterday. Almost a $3,000 rotation. It's come back down. It's rotated, taken some of the week longs out, and now we see a very nice consolidation taking place. And this is liquidity. Okay. It's a significant significant liquidity bucket. Whoever wants to be long is getting long inside this bucket. If we trigger ourselves back up above that 68,000, we are going to find ourselves back up towards that weekly high pretty fast. Okay, like I said last week, we were a little bit overbought. We were expecting this little bit of a pullback. It's now giving you a liquidity bucket. If you're not long, this is your bucket to try and get involved in, because once we get above that 68, we are going to move our way back up the page. Okay. Let's then turn our attention, talk about some of the data for today. It's very light. There's nothing really from a main data point perspective. We do have Bailey out today, and I think that's one to keep a close eye on. Of course, the UK did release its CPI last week. It was quite a significant miss. And, you know, we have seen the ECB pivot. They are now moving towards cutting at every meeting. There's talk of perhaps 50 basis point cut in December now that is surrounding the ECB. And it wouldn't shock me if Bailey came out today and opened the door to something similar from the BOE. Okay, perhaps a faster rate cut cycle. The UK economy is also very much in a very sort of low growth / recessionary type environment. So any support they can give the economy, they will take. And seeing what we are seeing within the inflation prints now, it wouldn't surprise me. So keep a close eye on that. What that does mean, of course, is that the pound has outperformed the euro, and the pound is holding up relatively well against the US dollar. So should we see a little bit of a pivot from Bailey today, don't be surprised to see the pound follow the trajectory of euro, which is some significant sell side in the near term. Okay, apart from that, we are of course still waiting for the Israel strike on Iran, and once we do have that, you know what to do. We've been discussing that for the last couple of sessions. Okay, that's it for today then. As always, good luck out there. Always manage your risk, and of course, go make some money.